Okay. What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we are going to be doing some stock analysis for Lime, otherwise known as Neutron Holdings. But I think most people are familiar with the name Lime because that's the name of the scooter brand. And this company is going IPO next week, sometime around, let's see, I think July 1st, it's expected. So, we'll see what happens with that as far as what prices the shares come out at. But Neutron Holdings or Lime is the largest global shared micromobility business, operating in over 230 cities across 29 countries. The company provides short-term rentals of proprietary e-scooters and e-bikes through a vertically integrated platform that combines hardware, software, and tech-enabled operations. Founded in 2017 in San Francisco, California. So I've seen this company, in several different cities. I think there's a lot of people that do like using their products, and so I think this might be an interesting one to invest in. I'm not sure if I'm going to buy into it yet, but the valuation looks pretty accurate, pretty conservative. So they're aiming at a share price of around $25 a share. About $174 million is their target for the money they want to raise. And then let's see here. So and they're looking to pay down some of their one of their loans. So it looks like they're going to use a hundred and whatever. They're going to use some money to pay down some of their loan, and then the rest of it will be whatever's left over. Implied market valuation around $1.7 billion dollars, which is really not that much. It's not like a SpaceX type of valuation, so it's nice to finally see a fairly valued company. And based off of their numbers, it looks pretty good. Like revenue growth for last year, 880 million, which was up 29%. For the year ending March 31st of this year, revenue was at 927 million. So they're almost at $1 billion of sales, and the market cap's only going to be 1.7 billion or so. Now I'm sure the stock's going to jump up at least 10%, 20% or whatever. And so we'll be looking at closer to 2 billion, but still, that's a price to sales of 2 for a company growing sales at 29%. That's a pretty good valuation. As for the the net loss here, it's not great, but it's understandable. They posted a GAAP net loss of $59 million last year, which was actually worse than 2024. But they're growing, they're expanding, they're kind of a new company, so it makes sense. But 59 million is not that much. If you're doing $1 billion in sales and you lost 59 million, that's not that bad. Like I said, there's so many worse companies and valuations and financials out there, so this one is really not bad. Adjusted EBITDA was positive, so that's good, proving that operational profitability before accounting for interest, taxes, depreciation, and amortization, it's positive, $200 million, which is really good. So it's really just that, like I said, they have that loan, so they're going to pay off the loan. That's good, right? Then interest, depreciation and stuff. I'm sure that is actually a big cost for them, but once they pay off that loan, that should take care of the interest. And it looks pretty good. Full year 2025 free cash flow was positive. However, Q1 of this year saw a negative cash swing of roughly 79 million due to winter seasonality and heavy capex for upcoming fleet refreshes, which is to be expected. Now, they are the world's largest micromobility operator, and if you don't know, they do work with Uber. I think around what 14% or something is booked on the Uber app. They operate a shared fleet of e-scooters and e-bikes across 230 cities spanning 29 countries. They served 19 million different people last year. That's crazy. Reported 3.1 million monthly active users, which was 22% up year over year. They command roughly 27% of the global dockless micromobility market share and about 37% market share in the US, which is a very strong number. Keep in mind, I think DoorDash, I remember when DoorDash went IPO, their market share had to be like 45% or something. And I mean, sometimes all you need is two players with like a DoorDash and an Uber Eats or something, and that can be still pretty competitive. So 37% is a lot, but I think it could be more than that. There's definitely other companies out there offering the same thing. One of their biggest competitive advantages is the relationship with Uber, which dates back to a major restructuring and investment deal during the pandemic. Uber currently owns 24%, and they indicated interest in purchasing up to $20 million worth of shares, accounting for about 11% of the entire IPO. Wow. Lime vehicles are integrated directly into the Uber app. This distribution channel accounts for about 14% of Lime's total 2025 revenue, heavily lowering their customer acquisition costs compared to defunct or other peers like Bird, which is a great point. Major risks, regulatory dependency, and that's one where I'm like, okay, maybe 10 years ago that was a problem, but now they're already in 230 cities. I don't, obviously, that's not too big of a problem for them. And like I said, CapEx, that's to be expected. So then we come down here and we see that, okay, revenue trajectory is strong, going from 500 million to almost 700 million, 900 million, and now we're about to be at a billion. Unlike the early VC fuel days of burning cash, they generated $100 million in free cash flow and $200 million in adjusted EBITDA. Improved hardware durability means vehicles last longer, spreading CapEx over more rides. Uber is not just a passive investor, they are, like we said, integrated into the app, so that takes away any, a little bit of marketing spend they would have to do, so that's good. The most critical hurdle is the debt. Lime enters the public markets with about 670 million in debt payments, which, like I said, that's probably really eating into their EBITDA. That's a big interest cost. And so if they use the whatever 100 million, $200 million or so to pay down that debt, that'll make a big difference. Out of nearly 840 million in current liabilities, with only 260 million in cash, the S1 includes explicit going concern language. This IPO is fundamentally a rescue financing round to clean up a messy capital structure. Now, is that the best scenario? No. But is it the end of the world? No. I don't think that's a huge problem. I mean, it's lots of startups have this issue, and they have 260 million in cash. They're they're about to be profitable. They have positive free cash flow, and then they're going to raise 200 million or so from the IPO. So they're pretty much going to be able to pay this off within the next, let's say, 2 years or so. It's really not that bad. As long as they keep growing revenue the way they are, they're integrated into the Uber app, they expand into more cities, then we're looking good. Despite massive revenue growth and positive free cash flow, the net loss actually widened, which is not good. But again, that happens. They're not an old company. They're not that mature of a company, so that's going to happen. They remain entirely dependent on municipal permits. A city can change parking rules, cap fleet sizes, or revoke a permit overnight. Yes, and it's the same. You hear the same thing about Uber and stuff, and look how big Uber is. So they're targeting, okay, a $1.7 billion valuation. Enterprise value to revenue. Price of sales just under two. So see, it's really not bad. A company growing revenue at nearly 30%, two times sales is cheap, indicates that in underwriting, banks are aggressively pricing in the asset-heavy nature of the business and the looming debt wall to ensure the IPO actually clears. $100 million in free cash flow for last year, price to free cash flow of 16, not bad at all. And see, the valuation is fair, not if not conservative, and the valuation that accurately discounts their fundamental operational risks. So I I am interested. I thought about putting in a order for $27 from my price, but I don't know. I'm gonna think about it. Maybe I'll buy a little bit. We'll see. But I really don't think it's a bad idea. So that is my analysis for Lime or Neutron Holdings. Let me know what you guys think down below, and I will see you in the next video.